Imagine you've just bought your first investment property. Great, but what's the plan if you suddenly need your cash back out or if the numbers don't stack long term? Well, that's where exit strategies come in, and lenders actually want to know yours before they'll even give you the finance. This video was actually requested by Phil Carter. Thanks, Phil. And to be honest, when I first heard the phrase exit strategy myself, I thought it meant like you'd have to bail out of something quickly, like something went wrong. Cue the Indiana Jones music. But really, it's much more than that in the property world. It's about how you move on from a deal in a way that lines up with your bigger end goals. So let's break it down. There are three main levers that property investors use to build wealth, and those are short-term cash, ongoing cash flow, and finally, long-term growth. And when it boils down to it, every single exit strategy that you use is a different way of pulling on one or more of these levers. So let's talk about the first lever, short-term cash. When you're investing in property, the most obvious way to get short-term cash is flipping. So you buy a property, you add value with a refurb maybe, and then you sell it for a lump sum. It's the fastest way to grow your pot if you're starting out small. The upside of it is you've got quick injections of capital, but the downside is that you'll pay stamp duty, legal fees, agent fees, and then tax on the profit too. And if the market dips right when you want to sell, you could be stuck or forced to take a hit. So this is the strategy if you want results fast, but it's also the one that feels most like a job. So it's quite hard to manage if you do have a full-time job on the side. But that brings me into lever 2, which is ongoing cash flow. So this is where buy-to-let really lives. It's the absolute bread and butter of BTLs. You hold a property, you collect rent, you cover your costs like a mortgage maybe, and then you enjoy a steady monthly income. It is slower than flipping, but it builds stability over time. If you buy below market value, BMV, or you refurbish, you can refinance at a higher valuation, pull some of your cash back out, and still keep the rental income flowing. It's like recycling your money whilst holding on to the asset. And then finally, we've got long-term growth. So this is capital appreciation, and it's the big one. Over the long term, property values tend to rise, though of course they can fall too. But every strategy does actually tap into this lever in some kind of way. A flip does give you a good amount of growth straight away after your refurb because the property's grown in value. And also holding for maybe 10 to 20 years lets you ride out the market cycles, the potential dips, and lets you benefit from appreciation over time. This lever is less predictable, unless you've got a crystal ball, please tell me if you do, but it's where huge wealth is often built. So a lot of the time you hear people complain about property and boomers, and this is what they're really talking about. Decades of capital growth just doing the heavy lifting. So when you hear people talking about different strategies of property investment, like flips, buy-to-lets, BRRR, HMOs, they're all just pulling on one of these levers in different ways. So a flip, that's mainly pulling on the short-term cash lever. BRRR, which is essentially buy-to-let, but with a refurbishment and a refinance. You rent it out for the ongoing cash flow, you're holding it for the long-term growth as well. And then you're also refinancing it at the end to try and pull your cash back out too. So BRRR is actually pulling on all three of these levers. And to be honest, that's why I use it as part of my main strategy for my property portfolio. But there's the simplest exit of all, which is a repayment mortgage. So all of us with a mortgage have an exit strategy baked in anyway. If you go that route instead of interest only, you'll end up paying off the place outright in 20, 25, 30 years. And for some investors, it's the ultimate hands-off, low-risk way to build wealth, which is why it's recommended for our own residential properties. Because ultimately, we don't want to risk losing the roof that we live under. My wife definitely wouldn't forgive me. And then finally, an HMO, well, that's really pulling really hard on this ongoing cash flow lever. It's squeezing as much monthly income as possible out of a single property. So once you start seeing the property investment strategies this way, it's a lot easier to understand what actually fits your goals and which lever you want to be pulling on the hardest. So if you need to build your pot quickly, you'll be pulling hardest on the cash lever. If you want more monthly income to help cover your lifestyle maybe, that's when you lean on the cash flow lever. And if your goal is long-term wealth, maybe something like an early retirement in 20 years, then it's the capital growth lever that is going to get you there. So which levers do I pull most of the time? Well, for me, it's mainly cash flow and growth. So I'm refinancing and holding. Because I've already got my full-time job covering my day-to-day life, so my family, my car, my house, I don't need to chase the short-term cash just to get by. But that said, I always like to line up at least 2 exits on every deal. Take the house that I've just finished in Newark. The plan was to refinance and hold it, but I knew that I could sell it if I have to as well. So when I was evaluating the deal to purchase, I knew what the aftermarket value should be if I tried to sell it. Because it's good to have that backup plan. That's what keeps me comfortable making the purchase in the first place, knowing that it could work from a variety of angles because my situation may change. I may need that cash. But one last thing, As your portfolio grows, exit strategies become both more flexible and more complicated. You might refinance one property, sell another, restructure across multiple ones, and it stops being about each property in isolation and becomes about managing the whole portfolio. So when I'm looking to propose an exit strategy for a new purchase that I'm making, I can lean on the fact that I've got equity in multiple properties that I could sell as part of my exit strategy later. But again, that is further down the line for most. And yes, there are advanced exits too, so lease options, seller financing, or tax deferred swaps. They are worth knowing about, but for most people starting out in property investment, it really just comes back to these three levers: cash, cash flow, and growth. So that's exit strategies in a nutshell. Flips pull the cash lever, holding refinancing or repayments pull the cash flow lever, and everything benefits from the long-term growth lever. The key is not just thinking about how you get in, but how you get out of a property, and how each exit gets you closer towards your ultimate goal, whether that be retiring early or bolstering your monthly income, or gaining a bit of cash for now because you wanted to buy a car or pay for a wedding. So through this video, I've mentioned refinancing a few times, and if you want to go deeper into refinancing, which is basically exit strategies on steroids, I'll put my BRRR video right here. And if you found this video useful, please hit subscribe so you don't miss the next one. Thanks again, Phil, for this topic, and I'll catch you in the next one.